Greetings. This is James Storms. It is 10:36 a.m. Eastern Standard Time on March 22nd of 2023. This is a very brief market briefing. I'd like to just cover my my sentiment towards the FOMC conference today. So let's just jump right into that. So we have a projection of a 25 basis point rate hike, which is basically what I'm anticipating. There was potential cards on the table for a 50 basis point rate hike, but here's the thing, right? So given the situation going on with Silicon Valley Bank and Credit Suisse, you know, two very, very big banks that have gone insolvent, a lot of moving parts developing with this. Overall, it was a very strong risk-off sentiment, a lot of fear baked into the market. However, the Fed has stepped in, and some other entities have stepped in to provide liquidity to kind of settle things down a bit. So let's take a look at the Fed balance sheet, for example, right? This is public information here. This is the balance sheet. For those of you who don't know what the balance sheet is, this is basically the amount of assets that the Fed controls, right? So we can see here, as the Fed started tapering their balance sheet, they started reducing their balance sheet. They started selling their assets to tighten up the economy, right? To basically stifle demand, to stop prices from rising and stop the devaluing of the US dollar. Ever since this banking crisis we've been experiencing, the Fed has pumped a large amount of liquidity back into the market. This is more quantitative easing. This is more printing money. This is more stimulus, right? This creates a risk-on sentiment. So this is why the markets have had this risk appetite for the past few days. Once there was general consensus that the market would be bailed out by the Fed, and once UBS purchased Credit Suisse, it definitely alleviated a lot of the fear that has been baked into the market. And now what this is causing is basically causing the projections of the Fed to loosen. And potentially today, I do believe we'll see a 25 basis point rate hike. I think the scenario that if the Fed were to pause rate hikes, meaning they would keep the rates at 4.75% and not hike, I think that would definitely send markets into the risk markets higher, indices higher, absolutely. However, there could be an adverse effect, that I'm just thinking about is, if they pause rate hikes completely, this could cause a fear of, what does the Fed know that we don't know? Like, what is actually wrong? Is there something deeper that we don't see on the surface? Are there more banks in danger? So if the Fed takes too much pressure off, that could be seen as a negative, an unintended negative. Is this something that I'm anticipating? But it definitely would be priced in, I would imagine, at first as a very strong positive for indices, right? If we were to take the pressure off all the way on the rate hikes. I don't think 50 basis points will happen. I don't think that's really very likely at all to happen. I think that's too much aggression. I think 25 basis points is what will be as expected. So what I anticipate for indices to see is a short-term relief rally first on the news. If it does come out as expected, I think that would be priced in as general stability, given the fact that we've already seen, like I said, stability re-enter the market with the backstop from the Fed and other things going on. So overall, though, we are going to go down. As I've been anticipating long term, we do have room to retrace here. So let's see how the data reacts. I think what's most important actually is what's said at the press conference here by Jerome Powell. I think the tonality that he adopts is very important, and I think that's what we should look forward to. What he says, and if he's hawkish or dovish at this conference. And pretty much, yeah. So if that happens, if he's hawkish, obviously we'll see a demand for the dollar. I do see the potential for us to continue. Like, the dollar will continue and indices will go down. It's just a matter of how deep is the retracement before that happens. So let's see what happens at 2 p.m. This is what I anticipate. I'd rather wait for the stimulus, wait for a more clear sentiment before we act, because we are in between moves. So do we reject this daily supply here, possibly here? There is confluence around these levels. So let's see, more data and then we can make a better decision.